Welcome back, everybody. Good to see you all again. Today, we're going to talk about being on track for retirement at age 40. We're going to go through some of the factors that we think are most important, how you can measure this, what are the assessments that you need to make to see if you are on track for retirement at age 40.
So what's going on in the media here?
Look, this is a terrible thing to Google for anyone. Every headline is scary. Not all of them. Some of them will take you to calculators that are actually okay, but there's a lot of scaremongering about retirement in general, kind of the anxiety or the insecurity around, are we ready to do it or not? Obviously, we're not going to be giving any specific financial advice here. That's not doable on YouTube to an audience that we don't know. So no advice in this video, but we're hoping to at least talk through some of the tools and talk through what a professional is going to do when they assess your retirement readiness at 40.
So the rule of thumb, as many have seen, is like you need to have saved for retirement between 2 and 4 times of your income by the age of 40. If you ask me where it's coming from, it's a kind of a calculation of averages, difficult calculation, but this is actually the number, between 2 and 4 times of your income.
What do you think about this rule of thumb? How would you assess its quality?
The biggest drawback, I would say, is like if your income is going to change a lot between now and retirement. And we're going to talk about that a little bit further. So this is a graph by T. Rowe Price, which kind of like tells you like how much you should have saved by different ages. So obviously, age 40 here is 2. It averages out for them between 2. I think it should be a little bit higher depending on the returns of your portfolio. If your income is going to change a lot between now and retirement, this is not really valid, right? This assumes that kind of like your income is going to remain more or less static or grow over time on an average basis. But if you have big jumps in income, like a big career change or, a huge promotion,
entrepreneurship,
salary, income for someone who is building a company, building wealth through assets or different things. You don't see that increase in wealth through income. You just see it through an appreciation of assets.
It's not going to be captured. And that's the real issue with this rule of thumb of 2 to 4 times your income. There are so many other factors. The point of this is not to have you freak out if you haven't saved 2 to 4 times your income or feel like you're behind on this. We're just dissecting one of the first things that you'll find if you go and look for this.
If you plan to retire in some of the areas or like very expensive areas, such as like the Bay Area or, New York City, this number obviously is probably, you're undershooting it here. You actually need to save way more.
This looks worse if you have a very high income and you think that that still applies where let's say you're making a high income and you're 40 in the Bay Area and you expect to stay in the Bay Area. You think you're functionally less on track just for being in a high cost of living area.
The numbers change a little bit because of taxes, but more or less, if your salary is high, the big problem is if you're saving now somewhere where the cost of living is low and also the salaries are low, and then you have to move to a higher cost of living area. So let's talk about what influences these retirement savings goals. First one that I think that is one of the most important ones is like, how much have you already saved for retirement? It truly matters if you are at the 10th top percentile versus, the middle of it. If you have already saved a substantial amount, that allows you to take on more risk. And if you take on more risk over long periods of time, you will earn more, and earning more will allow you to save more effectively, and just a virtuous cycle. And this is something that I guess people don't realize, that the wealthy kind of remain wealthy because they're just able to take on more risk.
That risk return spectrum, super, super important here. As 401ks have kind of evolved and, in my opinion, standardized towards, I think, index funds being like the gold standard of building blocks inside your 401k. I think a lot of people's retirement savings are getting more efficient, which is excellent news. But this risk return spectrum and how fast compounding goes is so, so important. The other thing to think about here is the difference in 1 or 2% returns in these portfolios from age 40. Imagine you're going to retire early at 58, 18 years of compounding. The small differences in compounding numbers turn out to be really, really huge.
And that's something we're going to talk about next is, first of all, like, when do you plan to retire, right? So when most people that I talk to, they say, oh, I'm going to work until 70. And the truth of the matter is that it actually isn't always the case that you can. Employers may not want you. And many companies have mandatory retirements as like 65 or 67. That could be a problem. Or you might have to take care of a loved one and that will force you out of the workforce early. When you look at the US population, who's working, the participation rate like in employment, only 25% of those between 55 and 64 are actually participating. From 65 to 74, it's much smaller. And then plus 75, I would say it's a small group of people that are just able and willing and probably wants to.
If you're 40 and you're on the way, you need to think about the longevity of your earnings period and know that each year in which you're in your peak earnings, which for many people is going to be in their 40s, your savings rate, especially like think about the difference in the first half of your 40s versus the second half of your 40s is really, really important. It gives you longevity. I like to think of retirement as it's a silly little metaphor, but it's kind of like landing an airplane. The earlier you save and the more that you have there is kind of like landing on both a longer and a wider runway. You just have more room for error.
This statistic really hit me hard. It's like only 28% of baby boomers surveyed have a backup plan for retirement income if they can't continue working, which is insane.
If you're age 40, are you an elder millennial or are you Gen X? I think that's the eldest millennial. So we're recording
1982, I think. If you were born in 1982, is the start of the millennials.
Got it. So we're talking millennials. So this will be a generational shift. How millennials are stacking up, I think, is objectively worse for retirement than baby boomers. But the big baby boomer tailwind that got them to a place where, this is actually healthier than what we expect for millennials is interest rates falling and a really, really good period of investments in the second half of the 20th century.
The other one that we talked briefly before is how will you invest your portfolio? And this comes to, if you have three big asset classes, right? Stocks, bonds, and cash. If you're planning on investing for 20 years, the percentage of observations that are negative go down to zero in stocks. And this is on a 20-year rolling basis, right? So if you take, we're right now in 2023, if you start investing in 2003, so it's been a 20-year period, that's one observation. So every month that goes by or every year that goes by is another observation. So like if you grab the 20 years, the percentage of observations that are negative is astonishingly, like it's 0%, so meaning that you do not lose money.
The longer the holding period.
Exactly. And so if you're 40 years old, you should be thinking of how do you maximize your investment returns during that period of time. And so you should be looking at probably the 20 year or 25, whatever you think is you're going to retire is like that rolling period.
Agreed. This is a great mental model as well for stocks. I like to think in terms of minimum time to positive. Minimum time to positive in my mind means what's a minimum holding period on which, even if imagine we're starting at the worst time. Imagine you're buying the peak of 2006 when the housing market hadn't turned over, or the peak of the tech bubble. You need to have that modesty to imagine that now is that bad time to invest, which for most people they go, oh my gosh, I just don't want to invest if that's the case, because of the uncertainty of the sequence of returns and when they're going to come. The better way to think about it is, yes, I need to invest because not investing is going to hurt me tremendously, as you can see by these returns on cash here. But in addition, from a risk perspective, this long holding period protects you so much. So this really needs to go into I was going to say calculus. This is not really calculus. This is more algebra, not even algebra, maybe arithmetic of returns.
You know what's interesting when I looked at this graph, and we're speaking now, we're in March 2023, and the interest rate on your savings is like, you could get up to 4%. I would say like 4.1% maybe. The average for the 20 years of cash is 4.8. So like we're below that still. Like, from a long-term horizon, we should still see a little bit more returns on cash if you want to just hit the average.
Agreed. It's funny. I've seen other people argue about this in the mortgage context, because mortgage rates at 6-7% currently feel really, really bad because the recent past was not in your favor compared to what it is today. But if you look back further or look to the 80s, there are more than a few observations of 12, 15, 17% mortgage rates. So it's really hard to extrapolate those forward. Look at markets and what they're expecting for a little bit of a guess and guideline there, but the rates on cash really do normalize things for all investors.
If you get a client who's 40 years old and you're looking at the retirement savings and they plan to retire when they're 65, would you put them mostly in stocks?
Caveat emptor for all things compliance. This is not advice, but yes, the stock market is a wonderful place to look for retirement savings for higher expected returns than you would have in bonds or cash.
And your preference is usually for indexes, right?
I think it is only because that's practical, low cost, highly academically researched, and understandable for many investors.
Yeah, I think the same. I mean, index traded funds, ETFs, are a wonderful instrument. I'm going to say here, you need to boost your retirement savings if you haven't yet. In most cases, I would say most people that I've encountered are not saving enough. They're just that runway, it's not long enough. It's not creating that extra room for errors. The whole idea of this video is for you to take action. Ultimately, the action we want people to take is just boost the retirement savings. Increase your savings rate, use any kind of company match, use the catch-up provision if you're 50 years or older, use the backdoor Roth IRA, use a mega backdoor Roth IRA if you have the ability to just increase the savings. Another thing that I've heard is that the best gift you can give your kids is not an education, a nice, cozy home, but rather not for them to have to fund your retirement or to have to help you while you are retired. Being independent from their help is probably the best gifts you can give them.
Agreed. And I think the other piece of that time is not on your side element is that waiting is very, very expensive. So compounding is still on your side at age 40, especially if we ballpark it at age 60 or 65, when you may start to take Social Security, maybe age 70, maybe we can delay it even further to age 75 by the time 40-year-olds retire. Every day of delay is expensive. Every ongoing year in which you're not able to maximize your savings rate is very, very expensive. Your future retired self or your future self who is evaluating the prospect for retirement will thank you for even these small changes.
For those who have questions, please leave a comment below. We're actively looking in our comments. We will answer them.